we're going to talk about a financial innovation that has completely changed how people save, send, and grow their money. Digital banks will walk you through what they are, how they work, and how you actually earn from them. Their pros and cons, some of the top digital banks today, and finally, a recommendation on whether this is a smart place to put your money. Digital bank, also called a neobank, is a financial institution that operates entirely or almost entirely online without traditional physical branches. Instead of walking into a building to open an account, deposit money, or apply for a loan, everything happens through a mobile app or website. To really understand digital banks, it helps to know the difference between a few commonly confused terms. A digital bank is a fully licensed bank, like Maya Bank and or Tonic, regulated the same way as BDO or BPI, just without branches. A neobank in some markets refers to a fintech company that isn't independently licensed but partners with an existing bank behind the scenes to actually hold the deposits. An e-wallet, like a wallet features of GCash, is different again. It is a stored value account, not automatically a full bank account with the same protections. Though GCash's parent company also operates GoTime as a separately licensed digital bank. Digital banks emerged as part of a broader fintech or financial technology movement, which gained real momentum in the 2010s as smartphone use exploded and a generation of digital-first consumers demanded faster alternatives to slow, pay-for-work heavy traditional banking. Globally, early examples like Ally Bank in the US and Revolut in the UK prove a bank could function without a single branch. In the Philippines, specifically, this shift accelerated during the COVID-19 pandemic when lockdowns made physical banking difficult and contactless transactions become a necessity. Recognizing both the opportunity and the risk, the Bangko Sentral ng Pilipinas created a formal digital banking license category in 2021 and notably capped the number of licenses issued to let the regulatory framework mature before the market got crowded. This is why digital banks are best understood as a genuinely new type of bank charter, not just an app version of an old one. Mechanically, how does a digital bank actually function? First, account opening via eKYC. You download the app and go through electronic Know Your Customer verification, submitting a valid government ID, taking a live selfie for facial recognition matching, and sometimes answering a few verification questions. This process, which used to take days at a branch, is completed in minutes because it's automotive using AI-based identity verification software instead of a human teller manually checking documents. The second is cloud-native infrastructure. This is the real technical difference from traditional banks. Old banks run on legacy core banking system, often decades old software tied to physical data centers and branch networks. Digital banks, by contrast, are built on cloud infrastructure from day one, meaning their entire operation, accounts records, transaction processing, fraud detection, runs on scalable servers like WAS or Google Cloud. Rather than physical branch hardware, this is precisely why they can operate with a fraction of the staff and overhead of a traditional bank. The third one is cash in, cash out network. Since there is no branch to physically deposit or withdraw cash, digital banks build partnership with existing infrastructure, convenience stores like 7-Eleven, phone shop, and other e-wallets or ATM networks. So, customers can still convert digital money to physical cash when needed. And the fourth one is regulatory oversight. Despite being branchless, digital banks are not unregulated. In the Philippines, they're supervised directly by the BSP, must meet the same minimum capital requirements as traditional banks, and deposits are insured by the Philippine Deposit Insurance Corporation or PDIC, up to 1 million per depositor per bank. the exact same protection you'd get from BDO or Metrobank. Automated risk and credit scoring. For anything involving lending, digital banks often use alternative credit scoring, analyzing app usage patterns, transaction history, and even e-wallet behavior, rather than relying solely on traditional credit history, which allows them to serve people who were previously unbanked or had no formal credit record. Now, let's get into the mechanics of how your money actually grows in a digital bank. First is the high interest savings account. This is the main draw. Traditional savings account in the Philippines typically offer around 0.1% to 0.5% annual interest, while many digital banks offer anywhere from 2.5% to as high as 6 to 7% per year. To put that in perspective, 50,000 sitting in a traditional bank might earn you around 100 to 250 a year, and the same amount in the digital bank could earn 1,250 to 3,500 a year. The second one is the interest crediting and compounding. Many digital banks compute and credit interest daily rather than annually or semi-annually like traditional banks. This matters because of compound interest. You effectively start earning interest on interest almost immediately, which accelerates growth over time even without adding new money. And the third one, time deposit or fixed terms. If you're willing to lock funds away for a set period, say 30, 60, or 90 days, digital banks often offer higher interest rate than the regular savings account, since they can rely on that money staying put and can plan its use for predictably. And the last one is promotional and referral incentives. Some digital banks offer temporary boosted interest rates for new users, cashback on bill payments or purchases, or referral bonuses for inviting friends. Additional, though usually smaller and time-limited ways to earn. Let's break down the real benefits and why each one exists. First is the higher interest rates. Because digital banks don't pay for branch rent, tailor, and physical security, they redirect those savings back to depositors in the form of better rates. It's a direct trade-off, less overhead, more return for you. The second one is a 24/7 convenience. Since everything is app-based, there is no 9 to 5 closed on weekends limitation. You can open an account, transfer money, or check your balance at 2 a.m. on a Sunday. Third is lower or zero fees. Most digital banks eliminate the maintaining balance requirement that traditional banks impose, where you're penalized for having too little money in your account, along with reduced or waived transactions and transfer fees. The fourth one is speed. Account opening, fund transfer, and even loan approvals can happen in minutes rather than days, because the entire process is automated rather than manually reviewed. Last is the financial inclusion. This is arguably the most socially significant advantage. In a country with over 7,000 islands, building a physical branch in every remote town is impractical. Digital banks let people far-flung areas who previously had no access for formal banking open an account with just a smartphone and an internet connection, bringing millions to previously unbanked Filipinos into a formal financial system. But digital banks aren't without real drawbacks. First is no physical branch to fall back on. If you have a complicated issue, disputed transactions, a large withdrawal, or a legal matter involving your account, there's no one to talk to face to face. You're limited to chat support, email, or a call center, which can feel impersonal or slow for serious problems. The second is technology dependence. Your access to your own money is entirely dependent on having a working smartphone, a stable internet connection, and the app itself functioning properly. A server outage, even temporary, can lock you out of your funds at an inconvenient time, something that simply can't happen if you're holding cash or can walk into a branch. Third is cybersecurity exposure. Because every transaction happens online, digital banks are a more attractive target for phishing scam, SIM swapping fraud, and hacking attempts. While banks invest heavily in encryptions and fraud detections, the user also becomes a bigger point of vulnerability. A single leak OTP or fake link can compromise an account. Fourth is limited product range for now. Many digital banks still don't offer the full suite of services a traditional bank does. Things like foreign currency accounts, safety deposit boxes, complex business loans, or in-branch notarization services. The fifth one is the trust and adoption gap, especially among older generation or less tech-savvy individuals. There's still hesitation to trust an institution that has no physical presence. The psychological comfort of saying your bank matters more than people sometimes realize. Here are some of the leading digital banks, especially in the Philippines context. Maya Bank, one of the pioneers offering high interest savings and integrated with the Maya e-wallet. CIMB Bank Philippines, known for competitive interest rates for flexible saving packets. Tonic Bank, the first purely digital banks in the Philippines, focus on high-yield time deposits. Uno Bank offers gold-based savings with attractive interest tiers. GoTime Bank, backed by Gokongwei Group and Time Group, combining app banking with physical kiosks in malls. Globally, well-known digital banks include Revolut, N26, and digital banks are best suited for beginners, students, and anyone who wants a safe, low-risk place to grow emergency funds or short-term savings, not for those seeking high, aggressive investment growth. Compared to riskier options like stocks or forex, digital banks offer stability and better interest plan a traditional bank, making them as a great foundational financial tool. But for long-term wealth building, they should be paired with other investments like stocks, bonds, or REITs rather than relied on alone.